Welcome back to the Pro Ticker Podcast, your Monday morning edition, covering major financial magazine headlines, everyone. We've got a lot to unpack today, from Netflix's potential price hikes to a surprising surge in the UK housing market. And of course, we can't ignore the inauguration happened today. Investors are definitely bracing themselves for what a new Trump administration might mean for their portfolios.
It is fascinating how these seemingly unrelated events can create a ripple effect across markets. Our job today is to help you connect those dots and understand what it all means for your investments.
Okay, let's dive right in with Netflix. Barron's is reporting that they're expected to have a pretty dominant year. But there are some interesting strategic moves brewing. Their article, As Hollywood Reels, Netflix's streaming lead is intact ahead of earnings, but expect price increases. It suggests they might raise prices and make a bigger push into live sports. Now, price increases aren't usually met with cheers, so what's the strategy here?
Netflix is walking a tightrope. They're betting that they can offer something their competitors can't: exclusive live sports, and that this will justify a higher price tag. It's a risky move, but it could be a game changer in the increasingly competitive streaming landscape.
It makes you wonder if this is the beginning of a trend. Could we see other streaming services following suit and raising their prices as they try to keep up with the content arms race?
That's a great question, and definitely something to watch. The article quotes JP Morgan analysts who say Netflix is increasingly focused on sports entertainment events and shoulder content, and predicting a bigger push into live sports as negotiating leverage shifts in NFLX's direction. This suggests that Netflix is playing the long game and willing to invest heavily to maintain its dominance.
Now let's switch gears and head over to the UK. The Wall Street Journal has an article titled, Average UK House Prices Rise in January, which reports that average house prices actually rose in January, the biggest jump at the start of the year since 2020.
What's interesting here is that this increase comes despite a significant jump in the number of properties hitting the market. The article mentions an 11% increase in new listings compared to last year. So it seems like there's strong demand from buyers, even with more choices available.
So is this a good time to buy or sell a house in the UK? It sounds like there are a lot of moving parts.
There's definitely a lot to consider. The article mentions the upcoming stamp duty deadline at the end of March, which is a tax on property purchases. This deadline is likely motivating both buyers and sellers to act quickly, creating a sense of urgency in the market.
So for anyone looking to jump into the UK housing market, they need to be aware of this deadline and how it might affect prices and competition. Now let's pivot back to the US, where things are getting interesting with the Fed. Bloomberg has a piece titled, Contrarian Bet Emerges That Next Fed Move is Higher, Not Lower, and it's turning heads. Some traders are betting the Fed will actually raise interest rates next, instead of lowering them. That seems counterintuitive with all the talk about easing up on rate hikes.
It's a bold prediction, and the article explains that it hinges on the idea that a new Trump administration might implement policies that could reignite inflation. For example, his stance on tariffs, taxes on imported goods, could push prices up.
So this bet is less about the current economic data and more about anticipating the potential impact of Trump's policies. But what about the recent inflation report that showed a cooling trend? Wouldn't that point towards the Fed lowering rates?
You'd think so, but the article reminds us that the Fed has surprised the market before. They can quickly change course if inflation starts to heat up again.
That's a good reminder that the market is unpredictable, especially with the new administration coming in, and the potential for unexpected policy shifts. Speaking of Trump, another Bloomberg article caught my eye. It's called Emerging Stocks Trade at Biggest Ever Inauguration Day Discount. It says that emerging market stocks are looking incredibly cheap right now, historically cheap, in fact.
The article points out that the MSCI Emerging Markets Index is currently trading at a significant discount compared to the S&P 500, based on their forward price-to-earnings ratios. This discount could be a sign of investor concern about how Trump's policies might impact emerging markets.
So is this a golden opportunity to buy low?
Mm-hmm.
Or a warning sign that something's brewing? It's hard to tell which way to lean.
That's the million-dollar question. There are two sides to this coin. On one hand, these low prices could be attractive to investors searching for bargains, but on the other hand, there's a risk that Trump's policies could create instability in these markets. The article mentions that if his policies trigger a risk-off sentiment, things could get messy.
So investors really need to weigh the potential rewards against the risks, and that can be tricky in a volatile market like this. Okay, let's move on to something a bit more perplexing. Barron's has an article that seems almost contradictory. Google search is doing fine. Why Alphabet stock may still be in trouble. How can Google search be thriving while their stock is potentially in trouble?
The article argues that the rise of AI, specifically AI assistants, could be the culprit, even if Google search remains dominant. Imagine if people start relying on their AI assistants to find information, make purchases, or answer questions. These AI assistants could still use Google search behind the scenes, but Google might lose out on ad revenue, which is their bread and butter.
So it's not about the quality of Google search itself, but about the way people access information potentially shifting. It's like being the best bookstore in town when everyone suddenly decides to buy their books online.
That's a great analogy. And the article draws a parallel with Microsoft and the rise of smartphones. Microsoft dominated the PC operating system market, but they were caught off guard when smartphones redefined what a computer could be.
That's a fascinating point. It shows that even the most successful companies can be vulnerable to disruption if they don't adapt to changing technology and consumer behavior.
Exactly. And this potential disruption from AI could extend beyond Google, impacting other web-based businesses that rely on advertising revenue, like news publishers and social media platforms. It could reshape the internet as we know it.
That's a sobering thought. Okay, let's bring Trump back into the conversation. MarketWatch has an article titled, "Here's What Stock Market Investors Still Need to Price In as Trump Returns to White House." And they point out that there are three key areas investors are watching closely: tariffs, deregulation, and corporate tax cuts. Let's unpack those one by one, starting with tariffs. What's the potential fallout for the market?
Well, tariffs are a double-edged sword. On one hand, they can protect domestic industries by making imported goods more expensive, but on the other hand, they can also lead to higher prices for consumers and retaliatory tariffs from other countries, which can hurt businesses and disrupt global trade.
The MarketWatch article quotes Mike Dixon, head of research at Horizon Investments, who says, "I believe that some of the tariff fears and risk have contributed a little bit to inflation fears and risk, and as a result, we've seen upward pressure on interest rates. So it seems like tariffs could add fuel to the inflation fire, which could then force the Fed to raise interest rates even more."
That's definitely a concern, and it highlights the interconnectedness of these economic factors. Now let's move on to deregulation, which is another area where Trump's policies could have a big impact.
The article suggests that deregulation could be a boon for certain industries, like finance and energy. Less red tape could mean more profits, which could translate into higher stock prices. But are there any potential downsides to consider?
While deregulation can stimulate economic growth, it's important to remember that regulations are often put in place to protect consumers, workers, and the environment. Rolling back regulations too aggressively could have unintended consequences. For example, looser environmental regulations could benefit oil and gas companies, but they could also harm the environment and public health.
So it's a balancing act, finding the right level of regulation that encourages economic growth without sacrificing important protections. Now let's talk about taxes, the third area that MarketWatch highlights. What are Trump's plans on that front, and how could they impact the market?
The article notes that Trump is expected to extend the corporate tax cuts that were passed in 2017. These cuts lowered the corporate tax rate to 21%. And Trump has talked about lowering it even further to 15%.
Lower taxes usually sound good to businesses. But what about the bigger picture? Could these tax cuts have any negative consequences, especially in the long run?
That's a valid point. Some economists argue that large-scale tax cuts can lead to higher budget deficits and increased national debt, which could have negative implications for the economy down the road.
So it's a trade-off. Short-term gains for businesses and the market versus potential long-term risks for the economy as a whole. It's something that investors need to keep in mind as they assess the potential impact of Trump's policies. Now let's shift gears and talk about a company that seems to be defying all expectations: Tesla. MarketWatch has a piece titled, "Tesla's stock is surging ahead of Trump's inauguration. What matters after that?" And it's pretty remarkable. Their stock has been soaring. And it's not just about electric cars.
It's true, Tesla's stock has seen a massive surge since Trump's election win. The article attributes this to investor excitement about Tesla's advancements in artificial intelligence and robotics. They're betting that Tesla could become a leader in these areas, potentially even surpassing their success in electric vehicles.
That's a bold bet. Considering Tesla's already made huge waves in the EV market, what specifically are investors excited about in terms of AI and robotics?
The article highlights Tesla's Cybercab robotaxi business and their Optimus humanoid robot as potential game changers. Morgan Stanley analyst Adam Jonas is quoted saying that these technologies could be Tesla's most valuable assets in the future.
It's fascinating how Tesla has managed to capture the imagination of investors, not just as a car company, but as a technology innovator. It makes you wonder how a Trump administration might impact their progress in these cutting-edge fields.
That's an interesting question. Some might assume that a Trump administration would be less supportive of these kinds of technological advancements. But the article suggests that Musk's close relationship with Trump could actually give Tesla an edge when it comes to navigating the regulatory landscape for things like autonomous vehicles.
It's a reminder that personal relationships and political connections can sometimes play a role in the business world, especially when it comes to industries that are heavily regulated. Now let's turn our attention to a different segment of the market, mid-cap stocks. Barron's has an article titled, "This Forgotten Market Sector is Set to Shine in 2025, Why Dole Yeti and Other Mid-Cap Stocks Look." And it's piqued my curiosity.
The article makes a case for mid-cap stocks as a sweet spot for investors this year. They're generally less expensive than large-cap stocks and have a solid track record of earnings growth. The article highlights Dole, the fruit company, and Yeti, the maker of high-end coolers and drinkware, as potential standouts.
Those are interesting choices. Not exactly the first companies that come to mind when you think of high growth potential. What makes them attractive to investors?
Dole is expected to deliver strong earnings growth this year, and it trades at a relatively low price-to-earnings ratio. The article quotes J.P. Morgan analysts who are bullish on Dole's financial health, highlighting their rapidly deleveraging balance sheet.
So Dole seems like a solid value play, a well-established company with a strong financial position and growth potential. And what about Yeti? What's their story?
Yeti has had a more volatile journey in the market. Their stock soared after their 2018 IPO, then took a hit in 2022 when sales growth slowed, but the article suggests that they're back on track and could be a good buy at their current price. The article quotes Timothy Schwartz, co-manager of the Schwartz Value Focused Fund, which has a stake in Yeti, as saying, "It's overlooked by the market."
So Yeti seems more like a growth play, a company with a strong brand and loyal customer base that's regaining its momentum. It's a good reminder that there are opportunities to be found across the market spectrum, from large caps to small caps to mid caps. Now let's move on to a story that's been making headlines for months, the TikTok ban. MarketWatch has an article titled, "TikTok is now back after shutdown. Under Trump, here's what comes next." And it seems like the saga continues.
Yes, TikTok was briefly offline over the weekend, but it's back online for now. The article explains that Trump has signaled his intention to delay the ban, which gives TikTok some breathing room. But the underlying issues haven't been resolved.
So it's a temporary reprieve. What's the latest on the government's efforts to force a sale of TikTok's U.S. operations?
The article states that the app could stay online for 90 days. While the government and other players search for a buyer, Trump has suggested a joint venture, where U.S. owners would take partial control of TikTok's U.S. operations.
But would ByteDance, TikTok's parent company, be willing to cede control of their prized app, especially considering the algorithm that drives TikTok's massive popularity?
That's the million-dollar question. Analysts are skeptical that ByteDance would be willing to part with their secret sauce, the algorithm that makes TikTok so addictive, even if they agree to a partial sale. The article quotes Wedbush analyst Dan Ives, who says, "ByteDance will never sell this key DNA."
So it seems like there's a lot of uncertainty surrounding TikTok's fate. Will a deal be struck that satisfies both the U.S. government and ByteDance? Only time will tell. Now let's shift our focus to Asia, where Bloomberg has an article titled, "A Trader's Guide to Navigating Trump's Trade War Risks in Asia." It delves into the potential impact of Trump's trade policies on various sectors in the region, highlighting both the risks and the opportunities that traders need to consider.
The article points out that chip makers are a key sector to watch. As U.S. restrictions on sales to China continue, these restrictions have actually created a tailwind for local Chinese chip stocks, but they've also raised concerns about the revenue streams of Asian tech giants like Samsung and Taiwan Semiconductor, which rely heavily on sales to China.
So it's a mixed bag for the chip industry. Some companies are benefiting from the trade tensions, while others are facing potential losses. What about other sectors? Are there any other notable risks or opportunities that traders should be aware of?
The article also highlights risks for the electric vehicle and battery sectors, as Trump's policies are seen as less supportive of these industries compared to the Biden administration. For instance, Trump has threatened to eliminate a consumer tax credit that was designed to boost electric vehicle adoption. This could hurt the sales of Korean EV battery suppliers like Samsung SDI and LG Chem.
So it seems like Trump's trade policies, along with his broader energy policies, could create some headwinds for the EV and battery industries in Asia. But are there any potential bright spots, any sectors that might actually benefit from Trump's approach?
Yes, the article mentions Korean shipbuilders as potential beneficiaries of Trump's policies, his plan to ramp up liquefied natural gas exports, as well as his focus on strengthening the U.S. Navy, could lead to more orders for Korean shipyards.
So even within the context of a trade war, there are still companies and sectors that can find opportunities for growth. It's all about understanding the nuances of these policies and how they impact different industries.
Exactly. And the article also mentions potential benefits for Indian business process management companies. They could see increased demand if Trump's push for government efficiency leads to more outsourcing of operations, particularly in the healthcare sector.
So it seems like there's a lot to unpack when it comes to Trump's impact on Asia traders, and investors need to be aware of both the risks and the opportunities. Now, before we wrap up, there's one more story we need to touch on that might seem unrelated to the financial markets, but actually highlights the interconnectedness of global events. Bloomberg has an article titled, "Israel and Hamas Swap Hostages and Prisoners as Ceasefire Starts." It's a significant development on a human level, but how could it impact the markets?
Geopolitical events like this always have the potential to create uncertainty and volatility in the markets. However, in this case, the ceasefire is generally seen as a positive development. It could actually lead to more stability in the region, which could be beneficial for investors.
So a potential upside for markets, at least indirectly.
Potentially, yes. The article mentions that Israeli assets have actually been performing well in recent weeks in anticipation of a ceasefire. The shekel, for example, is up against the dollar this year, and Israeli stocks have also been doing well.
So a glimmer of hope amidst the often turbulent geopolitical landscape. It's a reminder that even in the face of conflict and uncertainty, there are always opportunities for things to improve and for markets to respond positively to those improvements.
Absolutely. The article highlights some of the potential economic benefits that could flow from a more peaceful Middle East. It suggests that the ceasefire could eventually lead to broader diplomatic relations between Israel and Arab states. This could open up new markets and investment opportunities, boosting economic growth in the region and beyond.
So a potential ripple effect of positive developments spreading from the political sphere to the economic sphere.
Exactly. And a more stable Middle East could also lead to lower oil prices, which would be a welcome development for consumers and businesses around the world.
So a potential win-win situation. Peace and stability leading to economic prosperity and lower oil prices. Let's hope this positive momentum continues.
I agree. Of course, it's important to remain cautious and not get ahead of ourselves. The situation in the Middle East can change quickly. But for now, it's encouraging to see these positive developments.
Well, we've covered a lot of ground today, from Netflix's foray into live sports to the potential for a resurgence in inflation, from Google's AI dilemma to TikTok's uncertain fate, from emerging market bargains to mid-cap opportunities, and of course the ever-present influence of Trump's policies.
It's been a fascinating exploration of the current state of the markets and the complex interplay of forces that are shaping the investment landscape.
And we hope you, our listener, found this deep dive insightful and helpful as you navigate the complexities of the financial world. We'll see you all tomorrow morning with new headlines from major financials magazines.